Hi, Dave.
Hey, Platinum. How you doing?
Good.
It's 4 o'clock. Do we just want to hit the go button on this?
Sure.
I mean, yeah. We can just turn that down. I'd keep it in the background. What was that?
That was another sound effect.
Do you have these things? Oh my lord! All right. Will Dan be present soon? David, is he coming? No.
Yeah, he should be here. I sent Platinum his username. I guess it's.
So I did add him
You
as
did.
an approved user. Just ask him to raise his hand.
Oh, I see him. There he is. Oops. That's hard to. Jeez, it keeps moving. All right, there we go. Oh, I can't bring him up, but he's down at the bottom of the.
All the way at the bottom.
Yeah.
Well, for anyone that doesn't know, Dan is one of the co-founders of IEX. I was reading up on him before this, and it was like a news article, so I imagine there was some dramatization involved. But they described his job like hunting for signs of high-frequency trading predators. That's what he would hunt for in the IEX. He can give us more information, but it sounded quite cool, and I'm very excited to ask him some questions about high-frequency trading and order routing and how these things work, because I mean, some of this knowledge, man, you can't, we can look all over the internet, but still, some of it will just you can't find it. And
that's not overstating what Dan did. He's there he is.
Fantastic.
All right, well, he can introduce himself, but I'm gonna maybe I'll give him a little bit of a plug because maybe he wouldn't otherwise. But he's gonna tell you about his professional background. But Dan was one of the big characters in Flash Boys, and if you read the book, he was one of the puzzle masters. So when I met Dan, his nickname was Puzz, and that's how I knew him. So if that gives you a little initial background, I'm sure he can do a better job of introducing.
And Dave, what were you doing at the time? Because not a lot of people know.
Oh, well,
what you did for IEX.
Yeah, well, I met Dan as IEX was just beginning. We were the first people to be working there. And I was helping them to design the technology, but also, we were working closely on different techniques to protect institutional investors from high-speed traders. That was really what we had set out to do. So, hey, Dan.
Oh, yeah. Hello. Nice to be here, and thank you for the nice intro. And yeah, I mean, Dave knows as much as anyone about kind of the games that get played at that sub-millisecond layer, and so it was a lot of fun working together in the very, very early days at IEX. But yeah, I'm happy to be here.
Fantastic. So, Plaid, did you have any ideas about how to start this off? Because I can jump right in, I can start talking, but I don't want to run away with it. You know what I mean?
I mean, I think it would probably be a good idea to just kind of briefly go over why we comment on the rule proposals, going over the notice and comment period, and then I guess probably about how big are these rule changes, anyways.
Yeah, what is the reaction on the street? What's the gossip? We're on this side, and I can certainly try to infer what's going on. We had Citadel on the news last night being like, we're so great on retail and be so careful. So we have a sense of what they're doing, but I'd love to hear your take as well.
Yeah, I can start off. So the SEC has proposed 4 rules. These were proposed in December. 3 of them are, I would say, very substantial rules, with one of them probably being one of the biggest changes to markets in a very long time, and that's probably the one most people here will care about. So the 4 rules are: there is regulation best execution, and so that is the SEC taking on an official rule for best execution. Up until now, that was a FINRA and other SRO rule. And the SEC still had some level of authority there under anti-fraud provisions, but this would give them official purview over best execution and that's strictly for broker-dealers. The second rule is an update to Rule 605. So those are execution quality disclosures that have to be published by market centers. So this would modernize those disclosures, which haven't been updated since, I believe, 2001. So 22 years. And it would extend the types of firms who have to report 605 to include certain types of broker-dealers And it would also make it so that brokers have to put summaries of that information on their website to make it more accessible, primarily to individual investors. The third rule is an update to regulation NMS. And so this is the one in which they're talking about variable tick sizes. Today, the quote and trade increment on exchange is 1 penny. They're talking about shrinking that down to potentially all the way down to 1/10 of a cent. Although, we can talk about whether that's a good idea and if it will actually happen. But more importantly, harmonizing the quote and trade increment across on exchange and off exchange. So today, Citadel, Virtu, and the off exchange wholesalers have an advantage, a regulatory advantage over exchanges, in that they can print trades out to 4 decimals. That can't happen on exchange, except in limited situations under the retail liquidity programs, which are very small on exchange today. And so that particular element of that rule would harmonize and level the playing field. That's a big deal. It would actually remove one of the advantages that these firms enjoy over exchanges, and would push more volume probably on exchange. There's also
that, if I may, that was what Citadel talked about last night on the news when they were like, well, if you change something for everyone else and it's going to hurt retail investors, it just means that they can't do what they're doing right now to retail investors. It would, like, the exchanges can do it. So it's provided to everybody, which, we can talk about whether or not that's a good thing, but it takes their power away to be like, oh, we're so great.
But definitely, it reduces their ability to make some of their bogus claims that they make around execution quality, for sure. And then the combination of that and the other 2 rules, the best execution and the one I haven't talked about yet, the order competition rule, would really dramatically change the retail trading pipeline. Yeah. So the other 2 components of the Reg NMS rule are that they would drop the access fee cap. So today, the access fee cap is the most that a stock exchange can charge an order that's crossing the spread to take liquidity, and it's capped at 30 cents per 100 shares, or 30 mils. And they would be dropping that to 10 mils, except if there's a 10 mil tick size, then the cap would be at 5 mils. And then the last part of it is moving up some of the market data infrastructure rules, including the new round lot size definitions and odd lot. The inclusion of odd lots, not in the NBBO, but at least on the SIP. So that's a good advance for transparency. And then the final rule is the most controversial and the one that needs the most support from individual investors, and that's the order competition rule. And Dan, why don't you talk about that? You guys filed a great comment letter on it, and so you've done a good amount of reading on it, clearly.
Yeah, sure. So yeah, my co-founder. So I guess we didn't mention this. I was a co-founder of IEX, and I was the head quant at IEX for 7 years. But I left IEX 4 years ago to start a new company with my co-founder, Allison Bishop. And so she submitted a comment letter on this rule. And Proof Trading, we're an institutional broker-dealer. So U.S. equities execution agency broker-dealer. So these rules, this rule in particular, it doesn't affect us too much. I mean, in theory, it could, in that part of it is about having institutional investors interact with retail investors. But it's, that's kind of one of the more nebulous claims or goals of the rule. So, but basically, yeah, I mean, this is what you all were talking about, and what Citadel is not so happy about is this idea of taking the current retail trading, paradigm, which is almost exclusively retail broker to wholesaler, bilateral relationship, 100% of the order flow goes to this wholesaler, and they execute off exchange, and making that mostly not allowed, or at least a lot more complicated, and kind of forcing those wholesalers to expose orders into a competitive auction mechanism, in theory, to expose them to potentially better pricing. So you have this kind of, it's no longer allowed to just have it completely segregated from the rest of the market. And so kind of more specifically is, if the wholesaler is willing to trade at the midpoint or better, so give the retail broker and ultimately the retail investor a midpoint or better trade, they can continue to do that directly. They don't need to throw it into an auction. But if they want to do a trade at a worse price than the midpoint, which right now basically all market orders are traded, a de minimis amount inside the full spread. if they want to trade beyond the midpoint, at a better price for them, worse price for the retail trader than the midpoint, they have to go into an auction. And that auction is presumably going to be run by, I think, an exchange, or maybe there can be other auction providers. That auction has to be accessible to everyone. It's going to be on a 100 to 300 millisecond. There's a lot of kind of like more than you would expect. The SEC imposing kind of rules around how these auctions work.
Yeah.
And Dave can talk about that better than I can, but this kind of new auction mechanism with a lot of complication around how it works, but it has to be exposed to that. The whole market can participate in it if they want. If the auction goes off, great. If it doesn't go off, then the wholesaler can do a trade up to the price that they exposed to that auction. So it's kind of like if no one's willing to give that price or better, then the wholesaler can give that price. And so it's really interesting. I mean, it's like such a dramatic departure from how it works today.
And in terms of, if I may, just to make sure, the point is made that right now, Citadel and Virtue, they can be like, okay, I'm going to give you money, you give me those orders right away, or I'll pay these rebates, and then we'll make a deal together, and then you will send me your order flow. This is no longer possible. This whole, this direct purchasing of order flow by one means or another, payment for order flow or something else, would then be kind of prohibited. That no, you have to go over there. Everybody else has a chance to lure the kids away with candy, and then you can kind of do the white van thing and take the order flow back. So it's putting another step. It's not banning it, but it's making it so
it seems like it's still possible. It just seems like it's not, makes no sense to do it.
Yeah, and that was a really, really good line in the Platt, you put it. We have a chat, and she threw it in. It was a line from your letter on this rule. And what did it say? Can you pull it? I'm so sorry. It was so good that I wanted to highlight it, but I can't find it. It was the one about what this would essentially do, turn wholesalers into glorified market access providers, turn them into
that was from
right? Yeah.
That was from Proof Trading's SEC comment.
Yeah. That's from Dan's, Allston's comment letter, which is an excellent comment letter and a good take on the rule. I thought a very, very, very good points, and many of which I completely agree with.
Yeah, and this is essentially what these firms are facing down. And I guess how much of a step down are we talking? That it's a rule, and we're not sure how it's going to end up, and there's a lot of uncertainty all the time. We know, and you guys are very careful with your wording often, but it seems like this is very much kind of like a potential regime change, and they're sitting on top right now. They're having a very good time, but that's this is kind of the party's over kind of a deal.
Yeah, I think this would be a transformative rule for markets. You can tell by how dramatic the resistance to it is and who it's coming from. So the resistance is coming from the retail brokers, and it's coming from Citadel and Virtue, obviously. They are incredibly, Virtue, for example, is just shockingly, I would say, ad hominem in the way they are approaching supporters of this rule. They don't offer anything but insult, and it's especially hypocritical given that just a few years ago, Virtue was very much in favor of a rule such as this, not this exact form with auctions, but the idea that retail and orders from individual investors should be sent to stock exchanges was a core part of the platform that I was pushing, and Virtue was one of our supporters. So, they were not in the retail wholesaling business at that time. They are now. So every firm that is opposing this stands to lose money, whether it's retail brokers who would definitely lose out on some and potentially all payment for order flow. You're right, it doesn't ban payment for order flow. But if the rule works and it moves a lot of this trading to exchange auctions, there's little incentive for the wholesalers to pay for the right to simply route the orders to act as glorified order routers. So, that stream of revenue would decline or disappear. Now, they're going to say that that's going to ruin the retail investing experience. You can't have zero commissions without it. It's a joke, these criticisms. Now, there are valid criticisms of the order competition rule. And in fact, I think, the comment letter from Proof Trading lays them out very nicely in what Dan is saying, that it's a very prescriptive rule, which means it's very specific as to the contours of what these auctions should look like. And I think that that's a mistake. I think you want to allow for some innovation here. And I can talk a bit more about like what I think we want to see and what our comment letter is going to say. But generally speaking, though, this would move trading out of the wholesalers and onto exchanges, and it would make it so that there's an order by order level competition, which is a good thing. And it would open up the possibilities of who you might interact with when you place an order through your retail broker. And it would not eliminate zero commissions. If that's something we want as a market, that's still something that's very possible. There, you have zero commission brokers in Canada without any internalization. It's illegal up here. You have zero commission brokers in the UK, where payment for order flow has been illegal since 2012. And so it's a joke. They come up with every argument they can because they're facing the loss of earnings and revenue and annual bonuses. But I do think luckily the regulators see right through that. So I'm not terribly concerned with some of those criticisms.
So from here, I mean, we have Dan here, we have you, Dave. We're like pretty well acquainted with your skill set and your expertise because you've been so generous in sharing it with us. But Dan, like, which parts of the rule do you think you're best fit to comment on in particular? Like, I'm personally curious about how does the tick size rule affect high frequency traders and like how much they're able to kind of like scrape and penny shave and those sorts of things. But there might be other things we could talk about as well.
Sure. Yeah, I mean, I can talk. Like I said, overall, these rules and the order competition rule and even the tick. I mean, the tick size rule is probably the one that affects us the most. The best X rule sort of affects us. It affects us, but it's also kind of in a lot of ways very comparable to an existing FINRA rule. And so in terms of like changes to our workflow, there's not that much, but in terms of the SEC taking a bigger role in best execution, which I think is a great thing, because FINRA and SEC are both regulators that oversee a firm like us. But FINRA is an industry, it's not a government organization, it's an industry self-regulatory organization. And so FINRA tends to be a lot more kind of toothless when it comes to fighting industry members for nefarious activity, whereas the SEC is the one that, sometimes will come in with a massive fine and really smack someone down. So I think the SEC having a role overseeing best execution is a great thing. The tick size one, yeah, it's a good question. I can probably talk a bit to, I don't know, profitability of market makers and that. I guess with a lot of these rules and the order competition rule as well, imposing a pretty big change to the market structure like this, it's almost always going to be a zero-sum game, overall. And there's going to be market participants that lose out from it. There's going to be market participants that gain from it. And you can see with the order competition rule that it's the retail brokers and the Virtu and the Citadels of the world that would lose out the most. It's probably the exchanges that are the most obvious winners. And you can see kind of probably in their comment, and I haven't really been following the comment process, but I'd imagine the comment letters really reflect the individual firms' profitability outlooks. And it's kind of like everyone always just talks their own book in this world, and it's pretty demoralizing being a market participant and like trying to engage in the discourse, and everyone is just like so blatantly speaking their own agenda, and there's not really that much people. I think Dave is a really good example of someone who like doesn't really have an agenda. He's not profiting from exposing sharing his insight and knowledge and experience with you all, but like he's willing to do that because of whatever moral or ethical or feels it's the right thing to do. In this industry, it's so rare. But anyway, the tick size stuff, or I don't know, Dave, if you want to chime in, but the tick size stuff, yeah, the proposal is to kind of pretty dramatically change from a penny tick to, in a lot of stocks, smaller ticks than that. I think my biggest question mark on this is what's the relationship between that and market data? And like Dave mentioned, odd lots would now be part of the SIPs in some way. I'm not super versed in the rule. I apologize in the rule proposal, but I'm kind of curious, like if you've got smaller ticks, then presumably you have a little bit less liquidity at each tick. And so the depth of books becomes a lot more important. And currently depth of book is not part of the SIPs. And like, I would love to see depth of book in the public feeds.
Yeah.
Okay. If I may just clarify for a second. So for everybody who's listening, if you're not familiar with some of those things, the SIP is the public feed for trade. So for example, but it costs money. At least some of the proprietary ones do. So I pay it. It might be like a few $100s a month, and you get every quote, every trade, but you don't get all of the orders, and that's depth of book. So like the demand, the orders that get placed and they get canceled, and all those other dynamics of the market, like you don't get them at all. And so if they were included, that would be a massive flood of important information for us that would also allow us to like go out and look for fuckery and do all the things we like to do, because right now it costs a lot of money. So that would be very exciting. The tick size rule. So if you've ever seen those screenshots where it's like, why does the price have 4 decimal places? Like, what is that? That's the calling card of Citadel and Virtue, who are allowed to do that, to go between these pennies and like scrape stuff and just kind of like I don't want to say front run, because I'm not really sure if that's the right word.
Step ahead, they call it. That's the legal version.
Thank you. Step ahead. And like say like, oh, this is price improvement because they're like 0.0035 that they did better. And this is the price improvement that they're talking about. So they get to do that. The other exchanges don't. And this rule is granting them that power. So it's kind of like, okay, the big exchanges aren't really our friends, but it's good that Citadel can no longer get this wonderful advantage and make the most of it. Sorry, Dave. Thank you so much for giving me that second. I just wanted to catch people up on maybe like you guys use a lot of terminology that maybe it's hard to keep track of all of it. At least,
Yeah. No, please jump in anytime.
For us regular people.
I'm sure Dan and I will use a lot of jargon and that we don't even realize sometimes. So yeah, please do. So Dan, you're spot on with getting depth of book into the SIP feed. It's something that people have been pushing for a long time. It was part of the market data infrastructure rules that were passed years ago, and which were supposed to be implemented by now. But the exchanges have quite obviously been dragging their feet on that because they don't want to implement some of those rules. And it's really going to set up to be a showdown between the SEC and the exchanges on several market data issues. But depth is not part of this, unfortunately. And it's a really interesting point that I hadn't thought about, that you could possibly make a pretty compelling argument that it should be, because as you shrink tick size, you're right, that you will lose some of that depth at the touch at the NBBO, and the depth view becomes much more important. I also think that shrinking tick sizes is probably going to lead to an explosion in market data, and that's going to be annoying. Not for like individual investors who don't really have to deal with it, but certainly for tech companies and others who are ingesting market data. But the tick size component, I think, is the second most controversial change in all of these rules. So the first is the order competition rule, and that's going to just get a huge amount of pushback from Citadel and Virtu and the retail brokers. And I know people might be using different terms now, but these brokers call themselves retail brokers, so I do have to refer to them as retail brokers.
Is that like Fidelity and Charles Schwab and those guys? Yeah. Okay.
Yeah. We can also call them wirehouses if you want. I prefer that term because it's a better description of what they do. And they really hate that term. If you've ever read Reminiscences of a Stock Operator, which you totally should, it's one of the best books ever written on markets. It talks about like pre-depression wirehouses, and it's best, I think, to equate the current batch of retail brokers with those kinds of firms. So anyway, the retail brokers and the wholesalers, who are all very powerful firms and very definitely have the ear of many members of Congress because they give a lot of contributions. They're the ones that are going to make a big stink about the order competition rule. But tick size is one of those things that not a lot of people outside the industry pay attention to, but a lot of people in the industry have some very strong opinions. There have been multiple proposals that have come out, one from NASDAQ called the Intelligent Tick Size proposal that I think is very good, one from CBOE. Now, this one from the SEC goes way beyond what anyone had ever suggested that should be done, taking the tick size in some situations all the way down to 10 mils or a tenth of a cent. And I personally think that's extreme. What the SEC is shooting for is they're shooting for spreads in which there is room in between the spread, that there's room in between the bid and the offer. And the SEC has determined that the amount of room should be between 4 and 8 ticks. And so depending on how what's called tick constrained a stock is that's the bucket it would go into for the tick size. So all stocks are currently in a 1 penny tick size. That means you can put a quote into the market, a bid, and it can go out to 2 decimal places, out to 1 penny, right? So the first change would be, if this passed, that they would add one more bucket, and that would be a half a penny. So then you would be able to put quotes at half a cent for certain symbols that are tick constrained, or whose volume weighted average spread, or I'm sorry, time weighted average spread, I think is 4 cents, would put them into a half cent bucket, which would be a lot of stocks, like half of stocks or something. I don't know, a couple thousand, I think. I'd have the number somewhere. And then after a quarter of that, they would look and see, are there still stocks that are tick constrained? And if so, those stocks would move down into a 20 mil, or 0.2 of a cent quote and trade increment. And then after another quarter, they would say, are there still stocks that are tick constrained? And those move down to 0.1 of a cent. I talked to a lot of people in the industry who know a lot about this stuff, and some are okay with it. If you're a high-speed trading firm, I think you tend to be okay with it. If you're a wholesaler, you're not, because it's starting to erode your competitive advantage. And some people think it's way too extreme. A lot of people are saying, why not just do like half a cent and quarter cent, 2 buckets? In fact, I think that's, well, I shouldn't say, but yeah, I think a few firms are going to come out and say that. And, you know, I think I'd probably fall around there, maybe start with a 50 mil bucket and see how it goes. I think that would be a more rational way than just kind of upending things like this. And a few people I've talked to are worried about the consequences to markets, and they want to make sure that there's a rollback mechanism for something like that if it does end up leading to flickering quotes and pennying, which means, you know, people jumping in front of others with, you know, de minimis price differences, right? If the quoting increment is 1/10 of a cent, so you're quoting at like 10.001, and someone jumps in front of you at 10.002. Like, did they really price improve enough to gain queue priority? Well, they would in this system, but you know, it can lead to some real problems that could disincentivize market making.
Yeah, and like, so the half penny, I heard that from Joe Saluzzi from Themis Trading, who tends to be like a kind of a voice for retail. Like, he's a hedge fund guy, so like that taken into account. But he was at the GameStop hearings and like just like trash talking Citadel and all that. So like, good, right? Has a good blog, nice. He says half a penny, and then also so does Citadel, right? They wrote a white paper on like how great their execution quality is, but then they also kind of said, well, why don't we just stick to half a penny here? So I think, like, maybe they're viewing that as, okay, we'll give a little ground, but then we keep our advantage, right? Like, that's not going to protect anybody from them if they can still kind of like go out to 4 decimal places or whatever and step ahead. So that would be my concern, I guess, as like an ignorant person.
I would think Citadel won't really care as long as 2 things are true. They'll take a half penny spread and quoting increment as long as, one, the harmonization piece of it is not put in place so that they're still able to provide de minimis price improvement, and 2, the order competition rule doesn't go through. And if you're Citadel, you know that if the order competition rule, the retail auction rule, is passed, you're going to sue the SEC and block it from being implemented for years. And, you know, look, every day they can block it is another day that they're basically printing money. So, you know, they're going to do everything they can to delay it as long as possible, because it's a, you know, that business of theirs is basically a money printer, and it helps fuel, you know, a lot of what they do.
Indeed. I have a question from something that Dan said earlier. It was about and I think you did as well. So it's about this tick size rule. It's about the inclusion of odd lot information in the SIP. Now, the problem that a lot of us have with odd lots is that they don't affect the price, and you have this redefinition of round lots. And what we would love to see is like the idea that in retail dominated names, in household dominated names, the odd lots that we tend to buy have a fair impact on the price. That's what we would like. And so in the rules, I'm not seeing that. But of course, like, I'm not an expert, maybe a little bit dumb. And I would like to know, so there is certainly a network effect between these rules, as we've kind of like talked about a little bit around here. And so if the odd lot is included in the feed, and now everybody is seeing like, hey, there's a better price from this retail household investor, does that then interact with their new best execution duty? So they can't just be like, oh, I have to ignore that odd lot because NBBO, or like, do you know the answer to that kind of a question, where like, is there anything that would be good for us in this inclusion of the odd lot, or is that just like what's the implication of that? I'm not sure.
I mean, I personally, and Dan, I'd be interested in your take. I find the best X proposal to be relatively toothless, in that it's not putting an order by order standard in place. So the retail broker doesn't have to change what they're doing today. It does make it more difficult to ignore. So it would, for example, including odd lots on the quote feed would mean that those statistics get incorporated into the execution quality disclosures rule 605. So it's a good thing. And it would, the best execution rule would basically says if you're engaging in conflicted transactions, that you have to check more boxes. Basically, you have to document some more stuff. But I don't find that, I don't believe it's going to really change anything. I think the hope from the SEC is that it will, that by including, by moving up these market data changes, making tick size changes, improving execution quality disclosures, and telling people that, the SEC is now policing best X, that even if the order competition rule is delayed or doesn't pass, that there will still be some significant changes, and there will be, but I'm not sure it would really impact that, that pipeline where, the orders of individual investors are sold and executed by wholesalers, sold to and executed by them. I don't know. What do you think?
Yeah, so like you said, best X, like there's existing best X rules in place that are instituted by FINRA, and these are very similar to them. And you're right, there's the I guess enhanced requirements for conflicted. I don't know, I haven't gone too deep into that, but definitely agree that the historically and today at present, what FINRA requires is pretty toothless. It's mostly documentation. If FINRA comes in and finds someone for violating best execution, it's usually like you didn't check, you didn't file this report in a folder. It has nothing to do with like you did this trade that was very bad for your client and very good for you and super, clearly not the best execution you could have gone for them. That's not what the fines are for. The fines are like, here was your procedures that you were supposed to follow and you didn't follow them exactly as you said you would. And so I think, moving it into the SEC's domain or adding it to the SEC's mandate, maybe it creates this opportunity for a whistleblower to come out and say like, hey, my firm, we had these closed doors meetings where it's like, we're going to trade against our customers or have this funky mechanism where we're getting extra kickbacks or payments, and like it's worse for our customers, but it's okay. And like someone who's sitting in that meeting reports it to the SEC, and the SEC can now come in under this new regime, under these new rules, and fine them for it. That would be great. Or someone has an email where they're like, haha, we're not getting best execution of our clients, and SEC reviews that email and uses that to fine them. But I don't think the rules themselves have like force any protection for the customer.
Okay, well, that's something to include in comments, because a lot of people, there was a funny screenshot that went out where it was like Fintel, I think, Platt, there was like, if you cancel, they're like, why are you canceling this? And the top new reason was like, data can't be trusted and the market is bullshit. Like, it was so... Like,
if you actually go to try to cancel Fintel, it asks you why you want to cancel, and that's the first reason. It's like the market is just corrupt and you can't trust any data.
That's like a serious enough problem that they're altering, like they're like, okay, how big of a problem is this? And the SEC is obviously noticing that retail/household has a big problem. And that's... enforcement's a really sticky point, man. And I think it's just like we have to include it in every single comment. Like, if you don't do this, none of this matters. And we want to see more of it. We want to see that, like, if somebody is profiting themselves at the expense of their clients, like, punish them, like, take them out. And like, I don't know.
Yeah,
I guess there's like not much. Yeah,
No,
there's not
no
much
doubt,
discussion
right?
to be
Like,
had there because like that's what we want. Sorry, please continue.
yeah, no, it's so frustrating. I've been, I said it to Gensler last week, and like I said, I've said it to FINRA. I don't understand what it takes for a broker dealer to lose their license, but apparently we haven't seen it yet, right? Like, these firms that manipulate the metals markets and the treasury markets, and they launder money and they screw their customers and they get fined billions of dollars or hundreds of millions of dollars, and they just lie and misrepresent all over the place, and they can still do business. It's extremely frustrating, and I don't think it's much of a deterrent. It's a cost of doing business. It's a cost borne by shareholders, and it's crazy to me. So I do think enforcement is an issue, but I don't think that that's a reason to be cynical over some of these rule changes. And let me tell you why. Because there are certain rules in markets that are not subject to enforcement to work per se. And maybe that sounds weird, but like Reg NMS as a series of rules in the market functions extremely well because it has like very hard requirements. There's very little subjectivity to it. Now, I mean, you could say that there's some nuance to that, and people, can exploit some loopholes on the margins. But in terms of a set of regulations, a framework that knitted together all of the exchanges, established an NBBO, established these feeds, it functions. Unfortunately, a lot of the problems that would fall under NMS or market data costs or anything like that, they're all legal. The rules aren't being broken. They're not being enforced. They're just poorly written, or not even necessarily poorly written. But when they were written, it was a different time, and regulators weren't really thinking about certain unintended consequences of the rules. And a lot of the rule changes that we're looking at here, I'm not going to include best execution in that, because best execution, as Dan is saying, is something that really needs to be enforced. But something like the order competition rule, there's not, if that were to pass, there's not a way for it to not work, really, because like the only trades that can happen at wholesalers at that point would have to be at the midpoint. Like, you wouldn't see off exchange sub penny prints anymore as the de facto sort of standard. Now you would see some, but you would, all these orders would have to flow to exchanges. So, I think there's a case to be made that regulators don't enforce some of the rules, and that's a big problem. And I've been saying it's a big problem. A lot of people have for a long time. But these kinds of rules, if they are put in place, they will transform markets. It's not about whether they're enforced or not. I don't think, at least.
Yeah, and I think that's clear. Like they're. Oh, sorry, Dan. Please continue.
Oh, I was just going to jump in. When I was saying, when I'm talking about best execution in that rule and the existing rules, I'm really, thinking from my hat as an institutional broker, or for my seated IX as, predominantly an institutional stock exchange, where you're trading, 100,000 share, million share orders on behalf of large asset managers. And that's a situation where it's really, really hard to say definitively. I mean, it's impossible to say definitively. It's really hard to say, with any sort of objectivity, like this was a good trade or this was a bad trade, unless it's horrible execution, it's defensible. And so there's so much room just in the noise of the data to hide. And that's why best execution in the institutional context is a really kind of nebulous, fuzzy concept that's really, really hard to enforce, unless it's like literally the broker trading against their client and giving themselves a great price and the client a terrible price, like, which happens. Like, that does happen, and that needs to be enforced, and sometimes it's enforced and sometimes it's not. But like some taking a scientific approach and measuring execution in a real, like, thoughtful way is a really, really hard unsolved problem in the institutional world. And so, like, I think that the regulators aren't to blame entirely for not enforcing it, because it's really hard to enforce. And I think giving the SEC the mandate to enforce it, for the egregious cases, is a good thing. In the retail world, where most of the time you're trading within the spread, it's a lot clearer, right? Like, here's the price. Did you get that price, or did you trade through that price? It's a lot clearer. It's like, I think it'd be a lot easier to enforce for the SEC in the retail world. There are, like Dave was saying, just an example of kind of one of these corner cases where NMS or any of these rules are going to have some gray areas when the market's in transition. That kind of gives a big opportunity to the fast traders of the world. If the stock is $10 by $10.01 or whatever the tick size is at that moment, and it ticks up or it ticks down, like the market maker or the retail broker has an argument like, oh, I saw the old price. I thought it was still the old price, and I allowed this trade to happen at the old price because I thought that was the prevailing price. And whether or not they actually knew that the market had moved or not, those are the situations that are still possible.
Citadel got dinged for that like years ago, I think, when I was kind of like looking through. I was like, how does the TAQ work, and what is the SIP data and all that? That was an investigation that went on. And to your point about like the nebulousness of it, so about it last year, some ape got a hold of Citadel's like 2019 order routing protocol document, and so it was about 20 pages. And in that, they talk about that, like, oh, like changing market conditions, volatility, blah blah blah, like very lawyery. And they said like, oh, we prioritize speed. So like all these other things might fall by the wayside because like we're trying to go fast, but like fast means like other inaccuracies, other problems could, like maybe you don't get the press price, maybe they happen to get like got more profit on my side. And it seemed like they were setting up their priorities as an organization to defend shittier execution in a legal context, because there were so many variables going on that like they can basically do what they want, and who can say for sure if they were doing something bad or not. Like it is tough. So that's it, like the fact that like you could be like, okay, great, they can enforce, etc., but to actually catch somebody it seems extremely difficult, because it's a place where like it's like the lawyer place of power,
It is, and that's another point where people get upset that the SEC, as they perceive it, doesn't enforce the rules. But you do have to remember, like it's not an excuse. It's reality that the SEC is an underfunded agency, and their funding has dropped. Especially in the previous administration, the funding was cut, materially, and that's purposeful, right? It's kept to be underfunded, and it might sound like having 1,300 enforcement personnel is a lot, but you need to contrast that with the resources that these other firms have, and the fact that those 1,300 personnel are responsible for everything, not just the stock market, but the treasury market, which is critically important to the U.S.'s ability to raise money and fund itself, the municipal bond market, corporate debt, swaps, and certain types of swaps in which they work with the CFTC. I mean, it's like there's a lot that they have to police, and they every time there's a complicated case, the resources to investigate are really tremendous. The expertise is hard to get, right? You need to have data scientists and engineers, you need computer scientists, you need trading experts, and you need lawyers. And all of those people tend to go work for way more money at these firms. So, and then you've got the problem of the revolving door, right? Like there are all sorts of things that conspire to keep the rules from being enforced. And it's not just, what many people perceive as the corruption of the SEC, or what many people believe is, the relationship between the SEC and the industry. There's just a lot more. It's unfortunately a lot more complicated than that.
Yeah, that's why I was kind of excited by the prospect of the depth of book data, or just getting us more, that there's such like a wall made of like, you need to have this much money to ride, that where we could do more. And in my opinion, we have a lot of the talent required to catch these people and build these cases, but we just don't have access to the data, because exchanges are like, oh, it's going to be $6,000. Like, it's absurd. And
I mean, the SEC doesn't even have access to half the data. Like, nothing is really transparent.
I didn't know that. Get out. Oh,
there's a lot of data that regulators don't have access to. There's a lot of data that FINRA doesn't have. Like FINRA,
that's insane. That's insane.
They can go get any data they want, but generally speaking, it's not like they have a feed of this data. They need to enter an examination with a company, or they need to open an enforcement investigation. It's just not. Yeah, I agree that it's insane. technology has revolutionized other industries, and technology's influence on markets has really served to sort of concentrate money and power in fewer and fewer hands, unfortunately. And so
shocked.
Yeah, right. And so it is. It's very frustrating that regulators haven't adapted. I actually wrote about this, like 9 years ago, when I was presenting to the CFTC, and I talked about what I called regulators needing to sort of co-evolve with the markets and become regulators of these nonlinear systems, and how difficult it is and how technically sophisticated they have to get. And you can be assured nothing has changed since then. So it was just like yelling into the wind.
Good point. Hidden in that discussion, however, is the fact that if we come up with like a hint of something and then submit it to them and say like, hey, I think there's some fucked up shit going on over here, then they can be like, oh, maybe I'll just open the investigation and get the data. Like if there's just like enough justification to move further, I think that could work. That could be a thing that we do. But
yeah, the whistleblower program at the SEC is very robust, and if you come to them with good data, sometimes they might open an investigation.
Yeah, and they give 10 to 30% of the take, which is that's a hell of a bounty, man. Like some guy got $114 million last year. It was out of control, and he was just an individual guy who kept at them. So I don't know. That's the actual Robin Hood. But we got away from the rules. I don't know how to take questions from people. Platt, can you please be the adult in the room? Is that possible?
So if people want to leave questions, let's see. Let's take a look. We can ask the questions.
I saw a couple hands go up, but I had no idea what to do. There's one up right now.
Oh, yeah. So one thing about the SEC being underfunded is, I mean, could we put in our comments that they should just, charge double or triple for their fines? And then number one, it will make more sense, and disincentivize people to actually do those things. And number two, like maybe they can buy coffee.
So unfortunately,
a little bit of snark.
As good of an idea as it is, the SEC is not funded by fines. So this is like a weird nuance.
Oh, there's a special fund. It's true. They're not allowed to touch it. It's a thing.
So the money goes into the U.S. Treasury. The SEC is funded through what are called Section 31 fees. And so Section 31 fees are a small fraction of a cent on every sell order. And that fraction of a cent goes to the SEC, and that's how they get funded via congressional appropriation. But that's the source of SEC funding, actually. So it's a self-funded agency, but still subjected to congressional appropriation and not funded by fines, unfortunately.
Well, they should still double or triple the fines anyways.
Yeah, I think everybody should put that in. And as far as like enforcement or like investigation, I think that's us. Just like give us the data, let us do the things, and then we'll push it. I have more faith in like the hive mind than I do necessarily in expanding like just the amount of money that the SEC has, right? Like I think you get more from us from doing a little bit.
So on that, I mean, this was literally my job at IEX, was study the interaction between the market participants, and they're your direct customers, and exactly which firm is sending which order and in what situation and how they're interacting with each other. And it was amazing. I mean, it was so cool and learned so much. And we were able to build tools and pricing mechanisms to disincentivize the behavior or prevent the behavior that we found to be harmful. And it was amazing. I'll say a couple things. One, all the behavior that we consider to be nefarious, completely detracting from the market, adding zero value and purely extractive, 100% legal. Nothing was illegal. And so you have that data and you point out like, hey, these situations, maybe they should be illegal, but they weren't illegal and they aren't illegal. So that's one. Two, just having the data, like it's still a really, really hard problem. Even I 100% agree there should be more public access to data, but it's a really hard challenge to stitch together all these disparate data feeds from all these different exchanges and get a cohesive story of what's going on, or what each different participant who's in different geographic locations and different data centers, what they see at a moment in time. Like it's really, really hard. And number three, what I'll say is the public data feeds, the SIP, it's not free. It's public, but it's not free, and it's super expensive. At Proof, at our company, it's our single greatest expense is buying SIP data, is the public data. We don't buy the direct feeds. The direct feeds are way more expensive, the proprietary feeds. But even SIP data is super expensive. And Dave was mentioning this this rule from a few years ago that was, going to add depth of book to the SIPs. The exchanges proposed that the pricing for that extra depth of book in the SIPs was like astronomical, like crazy, like as much as the direct feeds cost today. And again, they're super conflicted in proposing the pricing. Like they're proposing the pricing for this public feed that's going to compete with their private feeds. So of course they're going to price it at an extreme price to make their private feed still valuable and profitable. So yeah, super crazy market and world that we're in.
On topic of questions, I don't think we could pass the mic right now. So like Japul, I see you. I've seen a couple other people raise your hands. Can you type the things into the thread, like into the post, and I'm reading them, and I will read them out because I want your questions to get in. So please do that now if you can. It's also fucking exchange data, man. Like that's the big thing. That, to me, that's the game changer. So like if we could advocate for that, I'd be thrilled. But going up against all the exchanges, why not?
So I can, this is an issue that I've spent a lot of time on too. Dan and I talked about it a lot too. And you might be interested, Dan, maybe you'd be very interested in seeing a comment letter that I helped with in Canada that was just filed, I don't know, maybe 2 weeks ago. So Canadian regulators put out a call to the industry to say, what should we do about market data, basically? And so I worked with some firms to put together a comment letter to propose basically a cost plus standard for all market data. It's similar to what Europe is trying to think about doing. Like they've passed this idea of a cost-based fee cap for market data. It's what IEX does. So if you read the comment letter, and I can send you a link to it if you want to post it. We go over like what the rest of the world is doing about market data costs and what we think the best solution would be. And our idea is that exchanges should be able to charge for market data, but only based on what it costs them to operate. And when IEX did the analysis, they found that exchanges were marking up the margins that exchanges were making on their market data. The prices that they were charging above and beyond their costs were anywhere from like 300% to 4,000% above what it costs, because market data is a monopoly. Each exchange has a monopoly over its data, and you need the data from each exchange. So it's like this regulatory created monopoly where there are no price controls, and so it's a complete and total mess.
100% agree. 100%.
I am going to also 100% agree. I'm going to read some questions now. So going down, we have Truth Road. My humble rebuttal to Dave on the SEC being underfunded is that Superstock alone can see the shenanigans that go on in the market with little more than autism on our side. And it's true that the idea that like if we can do it, like what the fuck are you doing? And
well,
I do think
there's a difference. No offense to Superstock, and I love you all very much. But there is a difference between posting things on Reddit and putting together a case that will survive in court.
We're gonna get there.
It is a big difference. It is not to diminish what is even the chair of the SEC said that SEC has looked at Reddit, is impressed with the DD. Like it's not to detract at all from it, but the standard in a courtroom is it's pretty significant, and the lawyers and the opposition that you're going up against, it's a bit.
I love it. Yeah, I think we'll get there. Like that's why I started paying for a little bit of proprietary data. I was like, all right, let's go, let's do it, see what's going on. And I think as if we get more data, we will be able to do this. And over time, it's going to develop in that way. So next we have, here's a good one. Jason, 1982. With these rules, during after hours and during pre-market, can institutions still sell each other millions of shares off exchange without impacting the price? Right. So this is kind of like the packaging up of shares into big blocks. And then we see these huge volume spikes, particularly after hours, just after, where it is theorized or it's seen as, okay, like where was this during the day? and why is this happening now? And there's just like after hours and pre, it's supposed to be low volume, so very volatile. Sometimes we see a transaction with 2 shares move the price like a ridiculous amount, like 1% or more. So like what is going on, and will these rules do anything? And as far as I know, like no, it's just I'm not sure. So like can you shed some more light on like what it is we're seeing and what's happening, and then B, is there anything in the rules that would even change this?
So I can potentially jump a little bit on just an example of what those trades could be. And, I'm not super expert on all the different possible scenarios, but for example, you might have a mutual fund go to a broker and say, hey, I want to buy 1 million shares today. And the broker might say, all right, I'm going to sell you that 1 million shares and I'm going to guarantee you whatever the VWAP price in the market is plus a penny. And that's going to be your price on that trade. And then the broker is going to be basically buying up that stock throughout the day into their own book. And then at the end of the day, they're going to flip all those shares to the client at that, market price plus whatever commission that they had agreed upon. And so you'll see that big block go up on the tape after hours. So it's not like it's like a trade where like basically the trading happened in the regular market, and then just the actual like movement from the broker's book to the client's book. That's what happened after hours. So things like that are very, very common. And so no, I don't think any of these rules would change that. But I also don't think that's like, nefarious, sketchy, inaccessible liquidity. That's just kind of like one of the ways that funds trade.
Yeah, I agree with that. So this is not going to affect things like outside of regular trading hours, which is, after hours trading. It won't, that's a time when the NBVO doesn't exist. There aren't really protections per se when you send an order. So yeah, it is generally a low volume, higher volatility session that you should be very careful about interacting with. Sometimes you have what Dan's talking about, the VWAP trades that print. Sometimes you have late trade reports, so a block trade that went off earlier in the day, but is being reported late. There are many explanations for why you might see that and why it might not be impacting the price, or why it might print outside what you might think is a reasonable price. And not all of them speak to sort of manipulative activities.
Okay, next one. Also, incidentally, from Jason, 1982. So this one, Dave, like we talked about ever so briefly a couple weeks ago, and that is, can they still naked short and sell stocks into the market that they don't own with these rules? And I think this this is about what happens with internalization, and then what is not allowed to happen if internalization is no longer happening. Like if something goes to the auction and gets picked off, it doesn't go into Citadel, and then these things can't happen. So could you guys speak to a little bit about how this, how the changes in price improvement statistics and the changes in the dynamics might affect the ability for internalizers to do things like naked short sell?
Like claim they're bona fide market makers?
Exactly.
Yeah, right.
Yes.
That's the issue. And no, this doesn't do anything with the bona fide market maker exemption to Reg Show, so they can still sell shares without a locate. And of course, that's an issue that is included in our the petition that is still running right now for We the Investor.
Does it affect their opportunity to do that?
It absolutely does, yes, and that's a really critical point. And I see often on Superstonk, what do we care about internalization? Let's deal with FTDs. Let's deal with naked shorting and all that. But like, you need to remember, like, this is where that is occurring, right? Where the internalization systems of these firms is where stocks are being sold without locates and are, through that exemption. So if more orders are going to the exchange and more trades are taking place on exchange, then, the market maker exemption is generally only going to be available for firms that are actually, making two-sided quotes on exchange. And I think that would change things, and it would reduce the opportunities that these firms have to internalize these orders. Yeah. But it does not specifically go after, for example, short selling or the market maker exemption. No.
Oh yeah, we'll be getting to that. That's for sure.
Yes,
like after this is done, man, it's on. But okay.
On to the next one.
Absolutely. So the next one is from Biotic 101, and they would like to really understand if the rules do in fact make the price manipulation / suppression we see in GME more expensive and unlikely. So this might be again related to internalization, right? They can pay for order flow, they can offer rebates, which is just payment for order flow under any other name, which smells as terrible, and then using that order flow and kind of using their position, say this is Citadel in particular, as designated market maker of GME to essentially control the NBBO. And so what effect would these rules have on their ability to do that? Probably involving the lessening of internalization, right? Like there's not as much of it going on. So like how could you explain kind of the NBBO control? And like Dan might be able to help on this as well, about how it might work and then how the rules might affect that.
Yeah, I could start, and Dan definitely, chime in or take it over. But, there is a case to be made that on a couple of fronts. One, that these firms, these internalizers, have access to an asymmetric amount of information, right? So they see all of the flow, both on and off exchange, and others don't get to see that off exchange flow. So one criticism you're going to hear, for example, about the order competition rule is, oh, this is just getting back to flash orders. And flash orders were a controversy from years ago that Direct Edge offered this order type that would like flash the order to a few firms before it was posted or sent to the exchange so that they could take the other side if they wanted to. And by that sort of definition, yes, the retail auction facility has some similarities to it, but it's a silly critique because today only two firms, basically, or three, get to see flash orders, and that's Citadel and Virtu. So, they're already getting these orders flashed to them, and then they can decide if they want to fill them or route them onto the exchange. So, that's that information that they get from that order flow and the aggregate characteristics of that order flow. That's valuable information. They're also extremely large on-exchange participants, and they can control some things. So, if they're internalizing a lot, people are buying a lot of a stock. And so they're getting increasingly short that stock because they keep selling it to people. They're in control of when they sort of release that pressure, right? When they want to buy, to lay off that risk, that short risk. And so I agree. I think that can, and I haven't seen any research. I would like to see research on this, but there is at least a theoretical possibility that this off-exchange trading of retail order flow can mute the buying pressure of retail investors, of individual investors, and
household investors now. Yeah. Didn't you know?
So it can mute that pressure and then sort of be released when the internalizer decides to, and especially with them being the on-exchange designated market maker, it certainly leads to issues. There used to be this guy who worked at a broker, and he was extremely anti-HFT, as anti-HFT as anyone could get. And he came up with this idea that was actually funny. It was called the 3-tick boogie. And it was about how the internalizers will manipulate the NBBO and move it around really quickly, like in the blink of an eye, in order to maximize their spread capture and minimize price improvement. Now, funny story, this guy now works at Virtu, and he calls all of the people that are pushing for these changes names and attacks them in ad hominem, with ad hominem attacks, even though we're pushing the exact same ideas that he pushed like 2 years ago when he testified before the House Financial Services Committee. So, there's just no shame in this industry.
Sidebar, where is this Virtu drama happening? Like, are they they're flipping out, calling people names? Like, where? Where can I see this?
They're just awful. I mean, Doug Sifu, when he goes, anytime he publicly comments, he talks about how this is just a political crusade. There's no data behind it. Yeah. These people don't know what they're talking about. This other guy calls you names and tells you you're defrauding people when you're just pushing for the same changes he was pushing 4 years ago. I mean, they're such hypocrites. It's astonishing. And they just have no, they have no ethics whatsoever.
Just money. So Dan,
hold on 1 second. In 2021, Doug from Virtu, he said about retail orders, he was like, they will look at that and say, my God, what a system this is. I have zero concern that there'll be some type of regulatory focus. I've spoken to the SEC at length about this. They understand it, and they applaud the environment as well. Yeah, he's not saying that anymore.
Yeah, that was the previous SEC. Like, there's 180.
Yep, that was
since
right
Jake Layton,
before Gary came in. Yep.
Yeah.
Yeah,
like,
he's
I got no
as
problem.
CEO, he's in deep trouble. Like losing 40% of your company's stock price as CEO, bye. Just shambles. That she said earlier. Sorry, Dan. So NBBO, National Best Bid and Offer, right? Price control. Could you like educate us a little bit about that? Because we talk about that a lot, like price is fake and etc. And so if an internalizer is getting like close to 100% of the flow from a retail traded name for one reason or another, like what can they do, and like what happens? Like that's something that is we can't easily find on our own, I guess.
Yeah, it's a really, because like again, most of the stocks that my customers trade that we're out trading, it's really hard for one market participant to like really manipulate the price, right? Like you have to take on a lot of risk to push the price in one direction or another for anything more than like a fleeting moment. But if in a situation like what you're describing, like in a GameStop or something where maybe Citadel or Virtue do really legitimately see 50% of the order flow in this stock, where they are, probably maintaining like a huge book, a huge position in one direction or the other at any given time. And where the public market is probably very thin relatively compared to kind of the amount that they're trading. Yeah, I mean, why not? Like they could. And like, again, this kind of goes back to the point where like these behaviors are, the rules aren't so explicit where like you're not allowed to manipulate the market, but what if you're just offloading your risk and like what is one and not the other? And so again, I don't know any, like, I don't have an example, but that probably is one where you're talking about where like when there is such a concentration of order flow among a very small number of market participants, where like even though the public market data or even private market data, none of the market data is attributed. You never see like, oh, this was a Citadel trade. You just see, oh, this was a trade, 1 mil off the MBBO, or this was a trade outside the MBBO, or it looks like it was outside the MBBO. But you don't know who it was. You don't know who the two sides of that trade were. But if it's a stock or type of security that's so concentrated in a couple participants, you could be like, okay, this is like a 75% chance it was either Virtue or Citadel. It's pretty interesting that like you could start to like dive into those dynamics and find some of these situations that maybe are manipulation or maybe are so nefarious that they should be illegal if they're not already.
Okay, thank you very much. And that's what I've been trying to do with the TAQ data, where at this point, like pre-tick size rule, should that ever happen, like 2025 or whatever, it's, you can tell because they go sub penny on those trades for retail trades, and you can kind of pick all of those out, and it is their calling card because it can only be them. And if it's inside these names, well, anyway, probably shouldn't be talking too much about that. But so Platt, again, please, if you would be the adult in the room a little bit. We're at 5:07. I don't know how long this was supposed to go on. I've kind of like gone down the list of questions. We only had a few, so we were able to answer pretty much all of them, which is fantastic. What should we do now?
Okay. Yeah, so I mean, I don't want to keep you guys for too long. We definitely appreciate you taking the time and just explaining this all to everybody who's actually interested in this now. I mean, we should probably talk about, like, one of the things we did talk about was, I guess, sort of like a plan for the comments. Like, Dave, you were saying that you didn't want to write the letter right away because you kind of wanted to see what everyone else was writing, and you didn't want everyone to see what we were going to write, type of thing. So can we just kind of talk about, I guess, sort of like a game plan for comments?
Yeah, absolutely. So I've been working on a lot on these, trying to formulate my thoughts and what I think the comments on these rule proposals could or should look like to best serve individual investors. That's sort of the approach that I've come into it with. And as I look through, what people are saying, we're not going to get many comment letters, I don't think, until sort of the very end. That's usually how these things go anyway. I will say this: if you look at the comment files, it is a beautiful thing, honestly. Just so many comments from individual investors saying, how they feel, and that, that mostly, almost universally supportive. It is hard to overstate how unique of a circumstance this is relative to, at least for me, the last 12 years that I've been involved in this, and how big of an impact it's going to have. So, I will never dissuade anyone from commenting. It is a great thing to be part of this process, to do it yourself, to say how you feel and why. There's nothing wrong with that. I would, of course, always say be professional and respectful in the comment file. It will be more effective. It's simple. You might feel very strongly about these things, but if you want to be effective, that's my advice for how to be effective. So from our perspective, from we the investors' perspective, my plan is that I think by the end of next week, I will have most of the comment letters prepared, and I'm going to start to sort of circulate them, make sure they're kind of like, say what I think they say, and make the best argument that they can. And then what we're going to do is we're going to put a website up for people on We the Investors, where you can look at the comment letters that we've written, and you can learn more about the issues. So Dan was kind enough and generous enough to agree to help me record some information on, we're going to put some videos together with him, with some other market participants, other members of the industry on each of the rules. So we're going to have sort of video overviews of each of the rules. We'll have links to some text, some guides to the rules. We'll have links to the comment letters that we've written. And what we will encourage people to do is one of two things. If you agree with those comment letters, please submit them. I'm going to try, I hope I'll have time, but I'm going to try to code something up so that it will be as easy as clicking a button. You'll put your name in and your occupation, you'll click a button for which ones you want to file, and it'll handle everything for you. So we're going to try and make it as streamlined of a process as possible.
Nice.
But if you want to write your own, and you want to take, for example, pieces of ours, you are welcome to do that. Absolutely. An individualized comment letter is more effective than a form letter, but that is not to dismiss the effectiveness of the form letter. And you can do both. There's nothing that says you can't submit multiple comments, and firms often do. So there's no reason that individuals can't as well. So I would say that what we're going to really focus on is for the last 2 to 3 weeks of March, maybe the last 2.5 weeks, we're going to have a full on, push for a comment letter campaign. And we're, it
Fuck
is
yeah.
up to us. Yeah, that's right. It is up to us to stand up and show the SEC that they've got the support of individual investors, and to show them that Citadel and Virtu and these retail brokers and wirehouses do not represent the interests of individual investors, and that they only represent their own profitability and their bottom line. I think there's nothing more important than that. And, we've seen it time and again from Chair Gensler in our interactions with him, and him stressing the importance of this comment process. As he said, the industry always shows up. And now it's time for individuals to show up and to show that, that you want these rules, and preferably on how to make them better. We've got a lot of ideas on how to make them better. I've crafted what I think is a really compelling argument to completely eliminate payment for order flow and rebates, exchange rebates. And, we're going to file that. I think we're going to, file something on the order competition rule that says, let's simplify this. Let's make it more effective. Let's open it up for competition and innovation, but let's still capture the basic premise behind it, which is to get orders out of the wholesalers and onto exchanges. And then, I'm not yet sure about NMS and tick sizes. I'm talking with some people that might be putting a comment letter together. We'll see on that one, but that's a probably. But the payment for order flow and exchange rebates letter will go into both files, into the best execution file and the NMS file, because both of them deal with payment and rebates. So, I think this is just absolutely the most exciting time to be a part of market structure. Frankly, this month is when it's all coming together. And so, I hope everyone is ready and willing to contribute and to get involved in the process and to make your voices heard. And, there's no better part of, helping to change markets and helping to transform market structure than being a part of that process.
Definitely. So far, a lot of the comments from industry are saying that they represent retail. So, oh, they
those
are.
guys.
The market is so efficient. There's so much liquidity. Everything's great. Nothing to see here. We shouldn't change anything. That will harm retail investors very much so. But then they don't even say how.
Yeah.
Oh, the audacity. Just,
There's a lot of hypocrisy.
So much just rank. I have one more thing, because I've been incompetent. I've sinned with the questions. I have one person. I'm sorry. Thank you for just like 5 more minutes, please. So one person is talking about, this is ringing bells, who we may know. He says, ask Dave to address Sapna Patel, head of America's market structure and liquidity strategy, Morgan Stanley, to talk about gaming the auction's 300 millisecond time. And she said it was an eternity when they're competing at the microsecond level, which is, and so I guess the concern was that she said this is BS because it's too long, so we can't do it. So I guess he wants you to address it, although maybe that would be like in your letter, because that seems like that's a heavy topic to deal with.
It is. I think it's one example of how overly prescriptive the rules are. I do think 300 milliseconds is an eternity. I've heard some very intelligent people say, it should be 100 milliseconds. It shouldn't be longer than that. That's plenty of time. I've also heard, this idea that why are we talking about these as call auctions, and why aren't we talking about periodic batch auctions, which is a different model? So a batch auction, for example, the way these are call auctions. So it means like an order comes in and the auction process is kicked off. Whereas instead, you could have a batch auction in which like an order comes in, another one comes in a few milliseconds later, another few milliseconds, right? So over 50 milliseconds, maybe you collect these orders, and then you have a batch auction every 50 or 100 milliseconds, provided there's interest. I like that model a lot, but I don't know that we want to be sitting here setting in regulation what the auction parameters should be, how long they should be. That's a dangerous road to go down, thinking that regulators know better on how to design these things than firms that are closer to the markets and who have, sometimes the profit motive is very good. And this is one of those situations in which exchanges that want to attract order flow are incentivized to design the best auction possible for, every participant, while, the regulator should be the one saying, here are the things you can't do, right? You can't give wholesalers an advantage in the auction. That's a good rule, right? You can't pay rebates to attract orders that are going to then be gamed or have poor execution quality. That's a good rule. But saying auctions have to be 100 to 300 milliseconds and you have to send on the market data feed every little detail about the auction and all that, like those are very prescriptive rules. So, that is something we're going to deal with in our comment letter. And I think Sapna is right, with this point, and that it's something that, again, like I said, these rules can all be improved. They're great starts, and they're opening a door that has never been opened in my time by the SEC, and that's to be applauded. But that doesn't mean that there isn't room for improvement, and this is a great example of something that can be made much better.
I mean, one thing I'll say from my seat, it seems like the industry just hates these proposals. Like,
yes,
the industry hates it, and that's pretty telling, right? I mean, very, very telling. And the other thing I'll say is, it seems more than I've ever seen. And I've, as long as Dave has, I've been following these SEC filings, and we've been doing our own filings when I was at IX and all this. So I've been very actively involved in the public comment process and the SEC rulemaking process. I've never seen an SEC administration that was so receptive to participation from the public, like, and not just the industry. And that's pretty cool and pretty refreshing. So
oh my gosh, 1,000%. Yeah.
Totally.
Like I thought he was like blowing me off. That's why I didn't even realize he was asking us, for another meeting when we talked to him. So yeah, it's awesome.
Yeah, well, thanks. Honestly, this was great. And, I know I'd be happy to do this again. It's a lot of fun, and it's a good conversation.
Oh, nice. Yeah, this was our first one. So thank you for coming, everyone. But yeah, we have a lot of questions about like FTDs and stuff like that, of course. And, other rules that have been put into place and are hopefully going to be put into place. Like the settlement rule is already kind of getting there, and then the short reporting rule will hopefully get there. So maybe we can have future talks about, those types of things.
I'm into it. Yeah. That's good.
All right.
Enjoy your Friday night, everybody.
All right. Have a good night.
Thanks, guys. Thanks, Dan. Thanks, Dave.
Thank you. Thanks, everyone.